Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Welcome to another one of these quick market updates, and we're using today's video to look at some of the best and worst stock picks here on the channel. Now, I went through every video to pick out the 3 best investments as well as the ones I'm not proud of at all. But why am I doing this? Why not just highlight those winners and pretend the losers never happened? That's what pretty much everyone else does anyway. Turn on the TV or just about any investing channel, you'll get hundreds of stock picks a month, but nobody ever talks about their record. You see these pundits on TV predicting the next big crash or a booming market. Here's a 2011 prediction for Dow 3000 by 2013, a 75% crash in the market. That actually ended up being a 43% return over those 2 years. And this guy was off by 118%. There's just no accountability. Okay, these pundits are on TV so often making different predictions each time that eventually they're going to get one right. And they eventually become, that guy that predicted the crash. And it's just as bad with professional analysts, though, too. I worked as an analyst and can tell you these guys can be miles off on their stock picks. But worse is that they generally chase a stock price all the way up and then follow it all the way down. We'll use these price targets for General Electric from Credit Suisse as an example. Now, I love Credit Suisse analysis. I think they provide some of the best analysis out there, but they're wrong just as often as any other broker. You see here, the analyst had a price target, a target price just over $32 for the shares in May 2017. That's 16% above where the stock was trading for and an outperform rating. Then the shares started dropping hard and the analyst cut their price target twice, but it was still always above that stock price, so always a buy on the stock. They finally just stopped covering the stock for almost a year to avoid reporting how bad the price targets were. They started covering the shares again, but immediately had to admit that GE wasn't worth more than about $12 a share. So besides just holding myself accountable to my own advice, and believe me, I am investing in these stocks that I recommend too, so I'm right there with you. But besides that, this kind of review can be extremely insightful to your own investing strategy. You look back at your investments, the best ones as well as the worst, and analyze what went wrong and what went right. It's going to make you that better investor, and that's what I want to do today. So first, we'll look at my sector stock recommendations. This was a series of videos we did in November and December on my favorite stocks from each sector. We'll look at how those have done, and then I'll reveal those 6 stock picks, 3 of my best investments, and the 3 I'd like to forget. We'll look at why those 3 did so well and what we can learn from the 3 worst. So here's a chart of the returns on each of these sector stocks, and returns here are from the date of each video from November and December. The average portfolio return here is negative 2.3%, which I'm not overly joyed about, but it's still better than that negative 5.7% return on stocks in the S&P 500 and a 15% loss on the stocks in the Russell 2000 index over that same period, so still outperforming the market. In fact, if you remove these worst 2 here, those shares of Luckin Coffee and Carnival Cruise Lines, which we'll talk about in a little bit, the portfolio would have a slight positive return, so pretty good considering this market. Now let's look at those 3 best and worst investments though, as some of these are from those sector videos, while a few others are going to be from other things that we've talked about. We'll look at the returns, what went wrong, and what went right on these. Now, one of our most recent recommendations was Grubhub, ticker GRUB, in a video on April 14th. The video revealed a secret meeting by private equity investors, and I highlighted Grubhub as a prime takeover target for its leading delivery app. Shares have shot up 46% in just a month and a half on news of a potential acquisition by Uber. And here we were looking for companies powering those long-term trends like home services, healthcare, and connectivity. Once you lock into what those trends are, that narrows down your list of potential stock picks from thousands into just a few. Now then what you want to do is you can find 1 or 2 with a strong advantage that could attract an acquisition buyer or just ride the stock price all the way up. Zynex, ticker ZYXI, is another recent one that I highlighted in a video of best stocks under $10 on October 2nd. Zynex was trading at $10.78 a share at the time and has surged 88% over the 8 months to over $20 each. Now, Zynex was much more of a fundamentals pick, finding those companies with strong financial results and the competitive position in a growing market. Zynex booked 12 consecutive profitable quarters, and orders were up 65% in the first half of 2019. The company is a leader in the medical devices space, but still just a $658 million company, so a small company, and I love the revenue picture on this one. The company earns about 60% of its sales on recurring monthly supplies to customers, so it's a very reliable income stream. Now, finding that kind of a company and digging into the financials means a lot of work, It's one of the reasons why most investors would do best just focusing on maybe 1 or 2 sectors to follow and then analyze those. So instead of trying to pick stocks from the entire market, you pick two sectors of the economy like tech or maybe consumer discretionary. Learn everything you can about those two sectors or even a few industries, and then focus your time on just finding the very best stocks in that group. Now, the best return so far has been shares of this El Dorado Gold, ticker EGO. I recommended El Dorado on April 5th of last year as one of my favorite penny stocks at just $4.58 a share. Now, the gold miner had some great assets, but was being slammed on problems with permits from the Greek government, where its biggest mines were located. Now, I had been following the news in this company for quite a while and knew that an election was coming up. Now, the problem was the socialist government and trying to get permits to conduct business in the country, but the polls were all pointing to some change to a more business-friendly environment. So I knew, though, that even if that change didn't happen, EGO still had some great assets and was undervalued at that point. Shares started rising almost immediately on hopes for the election and then shot up to $9.17 per share quickly afterwards. That's a 103% return over 4 months, though it's bounced around since then. Now, you can book 8% plus returns on the stock market over that longer term just by investing in good companies, by using some of those fundamentals that we look at here on the channel. It's a solid return, but for these double and triple digit returns, you really have to be in front of the market on your analysis. Okay, if there are any big geopolitical events coming up, you need to know what those are, how they affect your stock picks, and the odds on each. Now for the worst stock picks though, and we'll start with one of the most disappointing, Luckin Coffee, ticker LK. Now, I recommended Luckin as one of my top picks in consumer discretionary stocks on December 11th at $29.20 per share. The company was booming as an alternative to Starbucks in China, and the shares jumped almost immediately to $50 each within just a few weeks of that video. Then one of the worst things that can happen to an investor happened. It was found that the CFO was committing fraud by booking fake sales. The shares even stopped trading for a while that investigation was in place, and are now down 95% to just $1.39 each, though they are up 55% as I record this today. Now, of course, you're never going to know if management is committing fraud in these companies, but there are a couple of points that are going to help you avoid these. First is just be extremely careful with any company that's not complying with accounting oversight. So a lot of what we're seeing lately with these Chinese companies is because the Chinese government won't allow its companies to submit to an accounting oversight by the Public Company Accounting Oversight Board. That's the PCAOB here in the United States. That's a nonprofit company created after the dot-com crash and audits publicly listed companies, making sure their accounting is legit. Now, most companies with stock comply with this oversight by requirement, or even a lot of foreign companies just do it by choice, except China. You also get similar problems anytime you're investing in stocks listed in the pink sheet. So that's another thing that I want you to watch out for when you're investing in these very small companies, okay? These pink sheets, that's companies that aren't listed on the exchanges like the NASDAQ or the NYSE. These are usually super small companies, and there just isn't that accounting requirements that you find with these companies listed on the exchanges. So this is where you see a lot of that fraud in the U.S. markets. Now, that's not to say you shouldn't invest in shares of Chinese companies or these very small companies, but you absolutely have to do your homework into these financials and never have more than, I'd say, at most 10% of your wealth in any single stock. And that goes for even the bigger companies, actually. Enron was a $70 billion company before it went under, so you can't assume that just these big companies never are going to go bust either. Having less than maybe 5 or 10% in any single stock just helps you limit those oh shit moments that can totally wipe you out. Another bad investment here, Groupon, ticker GRPN, which I highlighted in December in our Stocks Under $5 video. Shares of Groupon are now down to $1.30 per share for a 55% loss, and it's not all on the coronavirus. Their shares had been falling for the better part of 2 years and plunged after the quarterly earnings in December. This was on weakness in its online goods marketplace, which it discontinued right after that, but there's still a lot of uncertainty around this business as a whole. Now, I actually still really like Groupon, and I own about 12,000 shares myself. I think this can rebound to about $2 or $3 a share. More than half the company's value is in cash, so it's a pristine balance sheet, and if management hadn't adopted a poison pill, I think this would easily be a takeover target by now. The lesson here, though, is that if you're going to be investing in these kinds of rebound stocks, companies that have been falling for a while, you absolutely need to understand the business model and have a reason for why these shares should rebound. You have to keep following the news, and if that thesis for the rebound, that reason for the rebound, doesn't seem like it's going to happen, you have to be able to cut your losses here. Also, you just can't expect some of these rebounds to go up immediately. Have a time frame for your investment, how long you're going to give management to prove that it can rebound, and then stick to it at that. Another tough one here has been Carnival Cruise Lines, ticker CCL, and I liked this one so much I put it in our 2020 dividend portfolio. I highlighted Carnival on December 11th in our best discretionary stocks video at $45.79 per share. The stock had a rough couple of years, but was rebounding on strong passenger demand, and the demographic outlook for this one was absolutely amazing. Then the bottom fell out. Cruise operators have been some of the hardest hit, and shares of CCL are now down 64% to just $16.28 per share. Now, nobody could have predicted the coronavirus, and nobody knew how bad this was going to get, but it does point out a great lesson in investing. One of the biggest reasons why investors lose money is because they just refuse to sell their losers. They're losing stocks. They hold on through a 20 or 30% or more loss, just hoping for a rebound, hoping just to get even after overwhelming evidence supports a change in their original analysis. Shares of Carnival started dropping in mid-January, even before the rest of the market, and by March, it was clear the entire cruise industry was in huge trouble. Selling at this point would have been a painful 27% loss, but also would have saved thousands by avoiding that additional 37% drop. Now, you cannot get emotionally attached to your stocks or just hope for a rebound. You have to be ready to take in new information and revisit some of your investments on these big news and events. Okay, look at your worst stocks and determine if there's still reason to believe that they're good investments at this point, right now, with all the news information you have. Click on the video to the right to avoid the value investing trap. 3 true value stocks in this market and the stocks you need to avoid. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.